Well, I've been sitting here all day. I've been sitting in this waiting room, and I've been waiting on my friends. Yes, I'm waiting on this conference call.
Hey folks, it's Frio here with Stock Talk Tuesday. So do you have some money set aside and you're like, I'm not putting it at risk to this because I'm looking to buy a house next year? Those are what the people I'm trying to talk to today, because I talked to a young couple over the weekend. Here's what happened is they said they had about $30,000. And I'm like, okay, how long have you had that money? They're like, well, we've been putting it away for the last couple of years. We have it set aside. We've had it sitting there for about 2 years now. And I was like, okay, what, you making any money on that? We just start talking about it. And they're like, we just have it sitting in an account, like a checking account, just waiting because we don't want to lose it. So that's a common practice in today's world, unfortunately. So today, what I thought I would do is help you guys understand this thing. So if you go to the website, like you go to CNBC or something like this, and you watch it and you're like, okay, what does this mean? Okay, so each week I come out here and my goal is to hopefully explain to you guys what all this is. But today I want to talk to those out there that really don't want to risk your money. You're out there and you're like, okay, I've worked hard for this money. I want to put it to good use in a year, maybe 6 months from now when I want to buy my first house. So where do I park it? Basically the safest spot that I can, because just sitting in the bank, we have inflation at 3%. So if you don't get at least 3% on your money, you're actually going backwards. So today we're going to talk about is the safest place that most investors move their monies. And the reason why I'm doing this today, folks, is I just want to help you out. I don't make any money on financial products. I'm a mortgage person. So if you're out there in need of a mortgage, my slogan is one application, one credit pool. We're going to compare your loan to over 30 different lenders. Now, I'll give you all that information if you're out there looking to buy or refinance. I'll give you my information at a later point. But my goal is to help people understand the markets, how to invest, how to be prudent with your investments, and really make sure you don't lose that money. So let's get over to some of the thoughts I have today. So if you're new to my channel, congratulations and thanks for joining us. But we created a stock portfolio about a year ago. And what happened was I had many people come out to me and say, you know a lot about the industry. Why don't you teach people just a little bit of how all this stuff works? Because if you're not in the market, folks, you got to get in the game. If you're not in the game, you're never going to win. So here's some of the stocks or the portfolio we created over the last year. And I just want you to see some of the returns. Our overall return for the day's down 1%. The market's doing okay today. But here's our portfolio that we created. We're going to dive into this a little bit. But we're going to talk about earnings season because that's what's really driving growth right now. Even the stock market, mortgage rates right now are really tied to a lot of this stuff. So we have a huge week of earnings reports coming in. We're going to look at that here shortly. But here's what I want to talk to you guys about. Where does the smart money put their money during, I guess, uncertain times? So here's what we've seen over the last couple weeks, maybe a couple months, is the market hugely volatile. And a lot of times, here's what you'll see the market say, and here's what I say a lot of times. Usually when the stock market is doing really well, the bond market doesn't do too well. But when the stock market doesn't do well and they know some bad news is coming, investors will pull their money out. And where do they put it? They don't set it in a checking account like a lot of times me and you do. They put it in some kind of investments. So today I'm just going to show you two bonds. And they're not exciting. They're not going to get you rich, well, maybe. But they're a safe haven to put that money there and at least beat the inflation numbers if you're not looking for any risk. Now, if you want a little more risk appetite, we'll talk about that in the latter portion of this section. And then before we get done, I am going to show you guys, you remember this week or last week, there was a regional bank scare. Everybody's like, okay, this is going to be systemic. It's going to go everywhere and the markets are going to crash and everything else. That was about a week ago. Have you heard much about it recently? Well, the same thing happened about Silicon Valley Bank, a bank back 2 years ago that went under. And there was reasons for it. They were a pretty badly run bank, and they went under. And everybody at that time said, here it is. Here's the start of that crash. So everybody's just waiting for kind of the rug to get pulled out from under them. So don't worry about the regional bank crisis. I'm going to cover a little bit of section of that here in a second as well. But let's get over to what we want to talk about today. This week, we're going to have a slew of earnings. Okay, so the markets are, I think, going to do okay. We're going to have a CPI number coming out later this week. President Trump brought in people from the government to create the CPI number. And the reason for that is Social Security recipients, they get their raises by the CPI. So whatever the CPI index is, well, that's the raise that seniors and people on Social Security get. So we had to get that number. So the government staff is coming in. They're going to provide us this week with the consumer inflation number. We don't know what that's going to come back as. Okay, so my reluctancy right now is I think the markets are a little overbought. And then if inflation comes back, jobs reports come back, how that data comes in, the markets are, they're going to be reactive basically day to day. So what do you do? What do you do to get your money into a spot that's as safe as possible? And let's get over to it. There's two areas you can look at. And here's what we've picked through. So I'm going to post this on our blog section, but I want you to understand what you're getting into here. These are two investment options. They're bonds. Bonds are basically this. When a company needs money, they can issue bonds. So like the government, they're out of money. We're $37 trillion in debt. So how do we pay our bills? Well, we go out there and we issue more bonds and bills and things like that. You can actually invest in those. Okay, so here's where they are. There's basically no chance of default. Yeah, the values can tweak a little bit, but here's what you're looking at. You don't want to take the stock market risk, want principal protection and predictable income. Are you looking for a safe haven? And you're looking for basically this to park your money 3 to 6 months. Let's go down to some of these things. What you're going to be interested in most likely is going to be short-term treasuries or tips. Tips I like, and I used to invest in tips a lot in the past. And basically they're treasury protected instruments, usually have a higher yield. So let's dive into both these assets for you. And what you can do is you can actually do this research on your own. So how many of you guys are using ChatGPT? Just give me a thumbs up if you are. Those are the ones I'm going to be interested in. I'm going to show you a couple of things here you can do with that. So let me know if you use ChatGPT. But here's the two different things you can get. I like to invest in ETFs. Okay, so an ETF is, think of it as a mutual fund or a basket of stocks. Okay, so I don't like, for example, somebody says, okay, do you like nuclear stocks? I do. There's actually one in our portfolio right there here. It's OKLO. This is actually a nuclear stock. I think nuclear stocks are going to be in vogue for the next 5, 10, 15 years. Okay, so we bought this last May. We're up, it's down today. It's down considerably today, 12%. We're still up 158%. Well, this is a perfect example. This is how volatile this stock could be. So let's say, for example, you bought in yesterday. You're like, okay, Dan, I love this stock. You've made tons of money on it. Now I'm going to jump in. Well, if you jumped in, you just lost 12%. Okay, that's why I don't like any individual stocks. I buy an ETF, which is a basket of these things. So what we do is we go over to here, and here's what I'm looking at. So if I want to look at a short-term bond fund, I'm going to look at two. I'm going to look at Vanguard and this one right through here, SHV. Okay, and here's what I want you to look at when you're doing your analysis. And you can do a lot of this with ChatGPT. I use Yahoo Finance. So let me know if you know if you guys would even mind. Let me know who you have a trading account with, because I just found out I've been with Schwab for, heck, I was in college at the time, so I was 20 years old. I'm 40 years, and they have the most clientele of any institution out there. I thought Robinhood and all those were starting to peck at them, but no, it's actually Charles Schwab. So here's what I look at when I come to this. This is short-term treasuries, and these are two of the ETF funds. And then over through here are tips, inflation protected. Okay, so here's what I want you to look at. Like, for example, this one has a 0.03 expense ratio. It wasn't able to pull up the 6-month return on it in investments. But over the past year, this fund gained 3.86%. Nothing to write home about, nothing that on any of these high flyers are doing, but it protected your money. Okay, at least it's squivered out at least the inflation rate. Okay, so at least you're not going backwards. This one, I would ixness because the expense ratio is too high. You had almost the same results and your expenses are 5 times that. Okay, so here's what I would do. And folks, don't trade on what I'm telling you or advising you to do. I'm not a stock advisor. I'm not a financial planner. I'm a mortgage guy. So you want to find out more about me, just go to therateupdate.com. That's my website. But if we go back to here, here's what I would look at. Looking at tips, treasury protected investments. Tip iShares, right through here, expense ratio. Tip Vanguard. Okay, so here's what these returns look like. Let's break it down. This expense ratio is 0.19. That's 6% or 6 times higher than that. Okay, but let's go to the next thing. Over 1 year, this returned 5.33. This did 6. Over 3 years, this did 4. That did 5. Okay, so I'm going to go with this one because it has the lowest expense factor It actually wins across the board. Okay, so then if you compare these two, I'm going to say, okay, I'm going to go with this one still because look at my returns on 1 year, 6.1 versus 3.8. Now, it's not guaranteed that these are going to repeat themselves, but we're coming up into an environment that we're not going to see huge differences in the next 30, 60 days, or so forth. So I would be putting my money into these tips. Okay. So that's basically, it's a bond fund that's basically protects you against inflation. So that's just kind of scratching the surface. So if you have money and you're just sitting there and you're like, okay, I can't afford to put this at risk. What do you do? Those are some things you do. Okay, so now let's scroll over to some other investments. I'm just going to show you just the highlights of what we went through. Then I'm going to show you what's happening this week because this is, if you're watching this for mortgage advice, if you're watching this for financial advice, this all plays a role in how everything works. So here's what I want to see. Do you guys think there's a CPI number coming out this week? And it's a number that we've been waiting for. The markets have been waiting for, the government's been waiting for, the Fed's been waiting for. What do you think it's going to come in at? So consumer inflation, that's the CPI number. Do you think it's going to be hotter than expected? Because this is going to play a huge role in where the markets go. Because if inflation comes back hotter than expected, well, you're going to see the Fed saying, wait a second, we know the jobs numbers suck, but we can't afford aggressive rate cutting. But if inflation starts to come down, you're going to see more aggressive rate cutting, and that's going to help the equity markets. Because now what you're seeing on all these bond funds, think about it, is the Fed cuts rates, all these bond yields are going to drop as well. Okay, that's not good news for that. So what a lot of people will do as the Fed's cutting is they'll move into equities or companies that pay higher dividends. So when you're doing your research, what you might want to look at as well is research some utility stocks, healthcare stocks, things like that are in good, even in bad times, they do pretty well. In an environment where we're seeing right now, where a lot of investors right now think the price of the markets are pretty elevated right now. So a lot of people are going to, move into some other areas into investing, and that's where I want you guys to find it. Okay, so here's some of the stocks that we've created over time, and the reason for these is right through here. So let me just break these down for you briefly, so you can understand some of these things are top holdings. So how I invest most of the time, I like getting into the stock market. I like bigger companies, solid companies. I don't like rolling the dice anymore. I don't want to risk my money. One thing I put my money into is the S&P 500. It's the top 500 U.S. companies out there and how they're doing. So if you look at this return right through here, you're first going to say, okay, that price, I can't afford $675 a share. Buy a third of a share. Do you know you can buy fractional shares of these things? So open an account with Schwab. They're the biggest lender out there. I think I even have a link down below. That's where I've had an account for 40 years because it's just simple. And look at this fund because you can put in $100 a month and buy, after 6-7 months, you have a share. Okay, but here's what I want you to look at. Look at the returns. This is the S&P 500, the biggest companies in the country. Here's what I want you to look at. Has a yield 1%. Nothing really to write home about. A PE ratio of 28%. That's kind of hefty. Year-to-date returns 15% so far this year. You think that's good? Let's go back to a 5-year chart. This had a hold on. Logging into charts, IBV. I don't know. You guys having problems with the AWS server as well? But look, a 5-year return, 96%. So basically, you doubled your money. Okay, over a 5-year return on just the top 500 companies. This isn't even like you're not rolling the dice on all this Bitcoin stuff and all the AI stuff. This is the top 500 companies. So yeah, you're going to have exposure in that, but that's what a lot of people are doing. So you have a top exposure, but again, is this where you're going to put your money that you need in 6 months to buy that first house? No, because it could drop just like this portfolio that I showed you. Let's assume that you bought that OKLO yesterday, or you jumped into Nvidia, or what was it yesterday? I think Apple. Let's see if Apple's in here. Apple's stock was up 15% yesterday, and let's see what it is doing today. And these are the things. I don't know. It's up today as well. So Apple, you're familiar with Apple. So when you're looking to invest, also think about what are things I know. Do you know what Bitcoin is? If you don't invest in it. Do your research. Okay, this right here, let's look at this one. This is Apple. You have an Apple phone? I got an Apple phone. I got an iPad. I got earpods. My kids got Macs. Everybody's got an iPhone. Everybody, So I know Apple. I've owned Apple for 15 years now. Let's just not bragging on this one. Let's just go out on a 5-year return, 125% return on your money in 5 years. So I've owned Apple for probably, like I said, 15 or 20 years. So great returns there. So these are just some of the things I want to introduce you to. I'm not a stockbroker. Like I said, let me just tell you a little bit about who I am, and then we'll move forward to, I want to talk about the regional bank thing just for a second. So folks, my name is Dan Frio. I'm actually a federally licensed mortgage loan officer. So I'm licensed in all 50 states as well as Puerto Rico. If you're out there looking to buy or refinance, I'd love to help. Okay, we have a slogan here I actually created. I'm trying to tweak it a little bit. Like, compare 30 mortgage rates or 30 mortgage companies or more than 30 mortgage companies with one application and one credit pool. It just doesn't sound good. So it's one application, one credit pool. We're going to compare your loan with over 30 different lenders. How we do that? Join me and Alan tomorrow. We'll have a live event, just kind of like this, where we actually show you, come in with your mortgage statement, know your credit score, join us live. We'll actually run pricing right on the screen. We're going to show you how we can compete for your business. We're going to pull up over 30 different lenders that we're set up with. So I'm at a federal, not a federal bank, but I'm at a bank and trust where I'm licensed in all 50 states as well as Puerto Rico. We're set up with over 30 different lenders to make sure you're getting the lowest rate and lowest fees in the industry. So now let's get over to this piece of the puzzle. The banking crisis that they kind of gave us the squirrel last week on. So Silicon Valley Bank, it was a bank a couple years ago, and there's a purpose and a reason why I'm telling you guys this. They failed. They went out of business. Okay, this was 2 years ago, right at the end of the pandemic and everything else. When everybody was skittish, the markets are waiting for. They pounce on just any bit of news, or good news, bad news. Usually, bad news just hits the streams. Well, Silicon Valley, they had some social media post about something about something. They had a run on the bank. Now, you ever watch? What's that Christmas Story thing where it's in black and white, and every time a bell rings, an angel gets its things. That was a bank run. What happens is people have concerns over the bank, so they go ahead and pull out their money and move it to a different bank. Well, that's what happened in Silicon Valley Bank. There was a rush on that. There was huge like AI and Bitcoin, and there was just the bank was hugely leveraged. And when the bank run hit, the FDIC and all the bank examiners came in and shut them down. And was it systemic? No. There was a couple different banks that went out of business. Now, every time something happens, it's just like the housing market. Housing takes a little bit of a dip. Oh boy, it's going to be worse than 2008. Folks, I hope the housing market never goes through another 2008. There really shouldn't be a reason for it because the products are gone. It really created that. And hopefully you don't have that much FOMO in housing anymore. So that's what we're seeing through the regional bank thing. So don't be afraid of that. Okay, so let's get over to any questions that you guys might have. And then from there, we can kind of take it away from there. Let's see, never miss a click on the chat. Okay, let's see the first thing we got. First question we have from Trump will replace Powell in May and put his guy in there. Rates are close to zero. No. Okay, so let me explain that. So if you go over, the Federal Reserve controls what's called the federal funds rate. Okay, what the federal funds rate is, it's the rate that banks lend each other money. Okay, so here's how it works. Let's say at the end of the day, Fifth Third Bank, that's who I bank with. Let's say they don't have enough money to close their books and be solvent. Based on banking regulations, they have to have X amount in reserves. Okay, so at the end of the day, they don't. So they're like, okay, what do we do? Well, they go to another bank, they get money lent to them overnight so they can kind of close out their books. Okay, so that's what interest rates they pay. So what's going to happen is the bond market, interest rates, they're guided by the bond market, and also mortgage rates are also guided by the MBS market, which is also mortgage bonds. Let me pull this up for you. Let's see if we can relog back in to my sessions. Okay, so here's what we have going on with the bond market today. MBS market. So I'll just explain to you a little bit of this, and I'm not trying to lose you guys. I just want to explain to you guys how it works. Unemployment is the key factor in future mortgage defaults, not bad underwriting. Well, the problem was you're saying unemployment is a key factor in future mortgage delinquencies, and I get it. But what you have to understand is to get a foreclosure, I think your assumption is there's going to be a lot of foreclosures. No, I'll get to that in a second, because there was an interview the other day that foreclosures on FHA are up 17%. You have to dig into those numbers. Like I always say, don't judge a book by its cover. Okay, so let's just dive in. I forget what I was even talking about at this point. The bond market's not going to go back down to zero. Here's what happened that really created how mortgage rates got to 2%. The COVID hit. Okay, the whole world shut down. When is the last time the whole world shut down? If you guys can give me a year, I'd love it. I'm waiting for a year. Okay, it's never happened before. So what happened was nobody's working. Our economy is a service, or a servicing economy. We like buying stuff and whatever. So what happened was the federal government and the Federal Reserve got together and they're like, okay, we got to help out people. So they started sending out a bunch of money, tons of money. And then what happened was the Federal Reserve, they went in and manipulated the market. So what they did is, here's the bond market. Okay, this is how mortgage rates are created. Okay, if the price of this bond goes up, and I talk about this every day, if the price of the bond goes up, the rates come down. Okay, so let's see how far back we can go. No, that doesn't work. Okay, so what happened was the Federal Reserve was buying this bond in the tune of $40 billion a month. $40 billion. Can you imagine $40 billion? Okay, so they're buying in the tune of $40 billion a month. The price kept going up and up and up and up and up because they're just bidding it up. Why? Well, because as the price of the bond goes up, rates come down. That's how they got rates down to like 2.5% on the 30-year mortgage. Will it happen again? No, I think they learned their lesson. They overfunded the government, or the people, and they actually pushed rates down way too far, and we're paying the price of it now with people being stuck in their home. Okay, so that's kind of what happened through here. And then we have trillions in debt coming due. I'm not disagreeing with anything you say. So that's what happened that caused rates to really get to where they are or were. Now, here, let's go to something else. And I do this every once in a while. And here's what I'd highly suggest you guys do. Stop, keep reading the media that you're reading and watching the TV you're watching. But do me a favor, use some AI systems just to check things. Okay, well, let's go over here. So let's get over to this. So is trillions in debt? Is the Fed buying again to prop up debt-based systems? Nope. They're actually, what happened the other day is they announced that they were going to end quantitative tightening. So let's go back to my chart. So here's what was happening. So they were buying. That's called quantitative easing. They're making money cheap, real cheap. Okay. So that's what they were doing. They were buying all those bonds. Okay. So that was quantitative easing. Then what they did is they started quantitative tightening not too long ago, a couple years ago. So, and then they started pushing up the rates. That's why we had a double whammy. So again, we already had the bond market, which people didn't like as is. So the prices were, let's just say, stable at best. But now we have the Federal Reserve coming in selling their quantitative tightening. Remember, easing, they're buying, quantitative tightening, they're selling. So they're selling. So we have a massive amount of people selling. Okay, so what's going to happen to the price? Price will drop, rates will go up. That's what we saw. Okay, so that's how all this works. Okay, so hopefully that gets a little bit of understanding there. Let me just do a few things for you. Let's go through, and I don't know which kind of I just want to debunk some things for you. If I could find something over here, market rally drives, virtual credit. You probably shouldn't be seeing my side views of something. But the other day I was just, for kicks, let's say, what's a question that we want to ask? How much debt does the U.S. have? This should be pretty darn simple. But dive into it. Ask it questions. Like and I'm not trying to get political, but let me just do this. I keep watching these news events saying 17 million people are going to lose healthcare and die. I'm like, is that true? Okay, so what I went over here and asked it is, will 17 million people die because of... And I know I'm completely off topic, but these are the things. My whole goal is I'm just trying to help you learn. Okay, I'm not a stockbroker, I'm not an investor, so please don't trade off my advice. But this is what I do. And so when I see news events, instead of sitting here getting all crazy about it, I actually fact check it. Short answer, no. There's no credible analysis showing 13, 17 million dies. 17 million figure comes from, all this other stuff and everything else. So do your research. That's all my point is. I'm helping you understand how all this works and the whys behind it. So the biggest thing that we want to focus in on the rest of this week, and I'll put it in this, is the markets are watching this. So yesterday, I'm sitting here thinking, okay, the government shut down. We have financial numbers we don't know. How's the job market? We don't know. How's inflation? We don't know. The China thing's going sideways. We have, fortunately, we have a bunch of wars stopped. But how are the markets figuring things out? Well, they're going right through here. And I've been watching data day after day for the last 24 to 48 hours. And everybody's saying the markets are based on this. And here we're going to end it kind of at this. We know the Federal Reserve is going to cut rates. There's 2 rate cuts in the charts for the end of this year. So we know money's going to get a little cheaper one way or another. So then we're going to start watching corporate earnings. If corporate earnings can keep up what they're doing, and they're killing it right now, and I'll have this in my closing bell, how the earnings came in, all the companies that came in with their earnings. As long as this comes in good, we're going to focus in on the jobs. Now, the jobs market is the area where, I'm going to have to agree with the person posting. We don't know where that's going to go, but I don't think it's going to be a huge crash in unemployment. So that's that part of it. Then the next thing is, here's the one thing I wanted to talk about, is FHA foreclosures. So now the big buzzword is going to be, if you're in real estate section of this is another area that I wanted to try to debunk. FHA. Somebody was saying the other day, FHA delinquencies just jumped 17%. So let's go back. FHA mortgage delinquency today versus what year was that? 2008. So let's see how this. Everybody wants to, compare things with the 2008. Well, let's see how it was. The overall delinquency rate. And I'm just reading this off here, so don't complain to the messenger. Today, the overall delinquency rate for FHA was 11% at the end of Q 2024. For Q2 of 2025, seasonally adjusted, it was 10.57. The serious delinquencies for FHA was 4.4. 30-day delinquencies up 12%. So they can pull their 30-day delinquents, or how delinquent are they? Let's go back to here. According to the 2008, FHA delinquencies was 6.9. Another source, FHA serious delinquencies peaked at 9.4, while currently overall delinquencies on FHA is higher than many conventionals. Delinquencies 4.4 is lower than the serious delinquency crisis of 2008. It was 4.4 now, and this was 9.4 then, so double. The suggestions that although FHA now tight, not bad, and so forth. It's not as bad. Okay, so that's basically what we're saying, is the delinquency rate today is a fraction of where it's been. And do all your due diligence. Don't trust what I'm saying. Go to ChatGPT, check the things I'm saying, because here's what prompted, and I'm going to end it at this. What prompted these videos was I was watching so many videos of people everything was just wrong. They were pitching what they wanted you to hear, and they were pitching their products. Okay, each day all I do is come in here. My whole goal is to help you understand how mortgage rates work, understand how the markets work, understand how interest rates work. And if you find credibility in me, I hope you use our services. Because if you're looking to buy or refinance a house, I would love to help you. And then let me get to one thing that we just created, and then I'll finish up with some questions and take it from there. If you're a homeowner right now, because this is the time of season where there's not a huge amount of buyers, but if you're a homeowner and you're trying to track interest rates, because that's what I do for a living, folks. I track these things, and I'm a mortgage advisor, and I'm licensed in all 50 states. So if you're out there and you're like, okay, I'd love to see what kind of rate I can get. Don't be surprised if you can get the rates in the 5s without any, paying any points and things like that. So how do you track these if you're a homeowner? I made the tool as simple as I can for you. Go over to the RateWatch. Here's our new revamped website. RateWatch 2.0. What this gives you the ability to do is tell me about your mortgage. What kind of loan do you have? What's the house value? Things like that. What's the current rate? What rate would you be interested in refinancing? Okay. So what's going to happen is I'll track these things for you. When the rate hits right around what you're looking at, I'll reach out to you and say, okay, the rate's there. Let's take a deep dive into this. Let's go over what your new payment would be. First of all, let's see how much this is going to cost you. What's your break even point? I have a video I was watching and I'm going to actually do, and I was trying to debunk some of the things that David Ramsey said, but he did come out with something the other day, was talking about refinancing that really made sense. And he broke it down. And so I'm going to present that in a video next week. And he said, as long as you can recover your costs within 2 to 3 years. So I'm a little bit, maybe I'll debunk that a little bit. If I can recover my cost this right now in this environment with under 1 year, I'm doing it. If I'm a year and a half, 2 years, maybe. And the reason why I say that is, folks, we don't know where rates are going to go from here. So if you're at 7.5, 6.5 or whatever, and you could save $200, $300, $400, and you can recover your costs within a year, do it. Because we don't know if rates are going to come down any further. If they go down further, maybe look at refinancing the numbers again. We'll put you right back in the RateWatch, maybe a 0.5% lower. So when those rates continue to come down, we can reach out to you. So that is it for today, folks. If you have any other questions, we do at my website right through here. You can ask Dan right through here. We have our phone number up through here. If you're looking to buy a house, here's one thing I want you guys to see. What a lot of people are having trouble with right now when they're refinancing is paying off that down payment assistance loan that they took. So before you take a down payment assistance loan, please watch this video, because this one has no payback. It's no lien on your property. It's basically free money. So check out this and a bunch of other tools that we have for you for homeowners, home buyers. If you really get confused with this, you're looking to buy, refinance, and just need some help, click right up through here. This is just going to request an appointment. You can have that with me or Alan. It'll just be a one-on-one, just kind of like this. We're here to answer any questions that you might have and just help navigate you through this whole process. So if you have any other questions, folks, I would love to answer those. But right now we have the stock market. Stock market's looking pretty good. You go over to cryptocurrency, it is doing fantastic as well. Go up to the earnings season. Right now, earnings day, look at all these companies with earnings. All these came in better than expected, other than one. One was down 2.7%, but look at GE. GE's up 17% on their revenue. Halliburton up 3.9%. 3M, what's 3M? It's up beats, and GM's up 8%. So markets are doing pretty good. Companies are doing good. After the bell, we're going to have Netflix giving us how's the consumer doing on there. And then tomorrow we have GE and a slew of other reports. So stay tuned. Join me tomorrow. I'll give you the opening bell on how all this factors in, and where it's taking these things and the whys behind it, folks. So if there's no other questions, I'm going to go for now, because we have people lined up to refinance. So thanks to you guys for watching. It's keeping us pretty darn busy. One last thing I'd like to ask you. We're trying to get to 40,000 subscribers. So if you can do me a favor, I don't usually ask this, if you can click the subscribe button down over there, I'd appreciate it. You'll get an alert every time I post a video, and also you'll help us get to 40,000 subscribers so I can reach more and more people to help them understand how the markets work, and especially how these things work. So thanks for watching. If you need any assistance with that mortgage, love to help you. Otherwise, have a